All right, let's dive into residual income valuation today. It's a crucial concept for any aspiring CFA charter holder, not just for the exam, but for your future as a sharp analyst, too.
Absolutely. This goes beyond textbook formulas. It's about developing an intuition, getting that deep understanding of what truly drives a company's value.
So we're talking about more than just looking at a company's profit and loss statement.
Yeah, we're going deeper. We're looking at a company's potential to create economic profit. It's like peering beneath the hood and seeing what's really driving the engine.
Okay, that sounds interesting. But can you break that down a bit further for me? What exactly is residual income, and why should I, as a CFA Level 2 candidate, care about it?
Think about it like this. When you invest, you're not content with just breaking even.
Definitely not.
Exactly. You want a return that exceeds your cost of funds, that hurdle rate. It's the same for companies. Residual income essentially measures the profit a company generates above and beyond its cost of capital.
So it's like a company getting an A plus instead of just a passing grade. It shows they're not just covering their costs, but exceeding expectations, creating real value for investors.
That's a great way to put it. And that's what makes residual income so powerful for valuation. It focuses on economic profit, the profit that truly matters to investors.
Okay, I'm starting to see why this is important, but I need a real-world example to really wrap my head around it. Can you give me a scenario where a company might look good on paper with accounting profits, but still have negative residual income?
Sure, let's take Axis Manufacturing, or AXCI for short. They were showing a profit on their income statement, but when we dug deeper, we saw their residual income was actually negative.
So they weren't generating enough return to cover their cost of capital.
Exactly. And that's a red flag. It suggests their current level of profitability might not be sustainable in the long run.
Interesting. It seems like residual income can reveal insights that traditional accounting profits might miss. So we've established that residual income is important, but how do we actually use it to value a company? That's where the residual income model comes in, right?
You got it. The residual income model is a powerful tool that allows us to put a dollar figure on that future growth potential we were talking about.
So how does it actually work? Can you break down the pieces of this valuation puzzle for me?
The model essentially has two main components. First, you have the company's current book value of equity per share. That's what's on the balance sheet right now, that snapshot of the company's net worth.
Okay, so that's like the foundation of our valuation. What's the second component?
The second part is where things get really interesting. We add the present value of all future residual income per share. This is where we factor in the company's potential to create extra value over time that premium investors are willing to pay for future growth.
Okay, so it's like today's value plus the extra value we expect the company to create in the future. But how do we actually calculate that premium? How do we put a number on those future residual income streams?
Well, that's where things can get a bit complex. It depends on our assumptions about how the company will grow and how its profitability will evolve over time.
So we can't just assume a company will grow at the same rate forever. That wouldn't be very realistic, would it?
You're absolutely right. Companies go through different phases of growth. They might experience rapid expansion early on and then transition to a more mature, stable phase as they get bigger.
So how do we capture those different phases in our valuation?
That's where the distinction between single-stage and multi-stage residual income models comes in.
Okay, now you've got me curious. What's the difference between these two approaches? And how do I know which one to use?
Well, let's start with the simpler one, the single-stage model. As the name suggests, this model assumes a constant growth rate in residual income forever.
That seems a bit oversimplified, doesn't it? I mean, how many companies actually grow at the same rate forever?
You're right, it's not always the most realistic approach. And that's where the multi-stage model comes in. This model allows us to factor in different growth rates over time, capturing those different phases of a company's journey.
So if I'm analyzing a young, high-growth tech company, a multi-stage model would probably be more appropriate. It seems like that would give me a much more accurate picture of their true potential.
Exactly. With a multi-stage model, we can break down the company's future into distinct stages, each with its own growth rate, return on equity, and other unique assumptions. It's like creating a more nuanced and realistic story of their growth trajectory.
Okay, that makes a lot more sense. But these multi-stage models sound a lot more complicated. What are some of the things I need to consider when building one?
Well, one of the most important concepts is the terminal value. This represents the value of the company beyond the period we're explicitly forecasting.
So if my multi-stage model forecasts the next 10 years, The terminal value represents everything after that. It seems like that could be a huge chunk of the company's total value.
You're right, the terminal value can be very significant. And there are different ways to approach it, depending on our assumptions about how that continuing residual income will behave in the long run. We might assume it fades to zero as competition catches up, or that it persists at a stable level if the company has a durable competitive advantage.
Wait, so the assumptions I make about the terminal value could drastically change my valuation. This is starting to feel like a high-stakes game.
You're catching on quickly. The terminal value is a crucial piece of the puzzle, and it's important to choose an approach that's well justified by the company's specific situation. Let me give you an example.
Yes, please. I'm a big believer in learning by example. Can you walk me through a real-world scenario?
Absolutely. Imagine we're analyzing Zenlandia Chemical. Now, depending on our assumptions about their terminal value, we could arrive at completely different conclusions about whether the company is undervalued or overvalued.
Okay, that really drives home the point that those terminal value assumptions can make or break our valuation.
Precisely. It's all about understanding the underlying assumptions and making choices that are grounded in a deep understanding of the company and its industry.
Okay, so we've covered a lot of ground already. We've talked about residual income itself, the model, and these single-stage versus multi-stage approaches.
Yeah.
But how does all of this connect to other valuation methods I might be familiar with? Does this stand on its own, or is it related to other approaches?
It's definitely connected. One important link is to the dividend discount model, or DDM. They're actually theoretically consistent, believe it or not.
Hold on. So you're saying the residual income model and the DDM should, in theory, lead to the same valuation. How is that even possible? It seems so different.
Well, at their core, both models are trying to capture the same thing: the present value of all future cash flows to investors. They just go about it in different ways.
So they're like two different paths leading to the same destination.
Exactly. But in practice, the residual income model might be preferable in certain situations. For example, if a company isn't paying dividends, or if its dividend payments are unpredictable, the residual income model can still be used. It's like having a backup tool in your valuation toolkit.
A bigger toolkit is always a good thing, especially in finance, where things rarely go according to plan.
Mm.
But you hinted that the residual income model isn't perfect. What are some of its limitations? What should I be cautious about when using it?
One limitation is that it relies on accounting data, and we know that accounting isn't always a perfect reflection of economic reality. As we saw with Axis Manufacturing earlier, accounting profits can be misleading.
So we need to be critical thinkers and not just take the numbers at face value.
Exactly. It's important to be aware of potential accounting distortions and be prepared to dig deeper into the financial statements to get a more accurate picture.
Okay, that makes sense. And I know there's a whole world of accounting considerations that can trip up CFA candidates. I'm ready to put on my detective hat and explore some of those nitty-gritty details. Where should we start?
One of the biggest stumbling blocks is this concept of the clean surplus relationship. It's a fundamental accounting principle that can really throw off your residual income calculations if it's violated.
Clean surplus relationship. That sounds a bit like something you'd find in a laundry detergent commercial.
It might sound simple, but trust me, it's important. Essentially, it states that all changes in a company's equity, except for transactions with shareholders, should flow through the income statement.
Okay, so basically any change in equity that isn't from issuing new stock or paying dividends should show up in the company's net income.
Exactly. But here's where it gets tricky. Real-world accounting doesn't always follow this clean surplus rule perfectly.
Oh no. So there are exceptions to this rule. What kind of things are we talking about?
Think about things like unrealized gains or losses on certain investments, or adjustments for pensions and foreign currency translation. These can bypass the income statement and go directly to equity.
So these items affect the book value equity, but they don't show up in net income. How does that impact our residual income calculations?
It can create a big discrepancy. If we're using net income to forecast residual income, but certain changes in equity aren't reflected in net income, our forecast could be way off.
So we need to be on the lookout for these clean surplus violations and potentially adjust our calculations to account for them.
Precisely. Let's take SAP's statement of changes in shareholders' equity as an example. It shows how other comprehensive income can bypass the income statement, and this is something we need to consider when calculating residual income.
So we can't just blindly trust the reported net income number. We need to understand where it came from and what might be missing.
Exactly. It's all about being a financial detective, digging beneath the surface of the financial statements to uncover the true story.
Now, this next question might sound a bit naive, but I have to ask, what happens when we're dealing with companies from different countries? Don't accounting standards vary all over the place? Wouldn't that create chaos for our residual income valuations?
You're absolutely right to raise that point. Accounting standards can differ significantly across countries, and that can definitely create challenges.
So how do we deal with that? Do we have to become experts in every country's accounting rules?
That would be quite a challenge. But here's the good news. Research has shown that the residual income model can still perform well across different countries. The fundamental principles of economic profitability seem to hold true regardless of where a company is located.
That's reassuring to hear. So even with these variations in accounting, we can still apply the core concepts of residual income valuation.
Exactly. The key takeaway is that the model isn't just about crunching numbers. It's about developing a deep understanding of what drives a company's true economic value, regardless of where they're located or what accounting rules they follow.
Okay, that makes a lot of sense. This has been incredibly helpful in setting the stage. We've gone from the basic idea of residual income to the model itself, and now into some of the real-world accounting complexities we need to be aware of. Where do we go from here?
Now that we've built a solid foundation, I think it's time to dive into the specific formulas and calculations you'll need to master for this CFA Level 2 exam. Ready to crunch some numbers?
Bring it on. I'm ready to level up my residual income game.
Okay, let's get into those formulas. Don't worry, we're not just going to throw equations at you and expect you to memorize them. We'll break it down step by step so you really understand how it all works.
That's reassuring. I'm definitely more of a concept person than a memorization machine. So where do we start? What's the most basic formula I need to know for residual income?
Well, it all starts with calculating residual income itself, right? Remember, we're trying to figure out how much profit a company is making above and beyond what investors expect.
Okay, so it's net income minus something. What's that something that represents the investor's expected return?
It's called the equity charge. Basically, you multiply the book value of equity by the required rate of return on equity.
So let's say a company has a book value of equity of $1 million and investors require a 10% return. That means the equity charge would be $100,000.
Exactly, you're getting it. And to find the residual income, you just subtract that $100,000 from the company's net income. So if they made $150,000 in net income, their residual income would be $50,000.
Okay, I see. We're essentially saying, hey, company, you need to earn at least this much to keep your investors happy. Anything above that is pure value creating profit.
Exactly. Now let's take this a step further and look at the residual income model itself.
All right, hit me with it. What's the formula?
Well, the basic formula is V0 equals B0 plus the present value of all those future residual incomes.
Okay, so V0 is the intrinsic value we're trying to figure out. B0 is the current book value of equity, and then we add the discounted future residual incomes.
Got it. But how do we actually calculate those future residual incomes? Do we have to project them year by year for like the next decade?
Yeah.
You could, and sometimes that's necessary, especially if you're using a multi-stage model with those different growth rates we talked about earlier. But there's another approach that can be useful when you're forecasting a steady growth trend in residual income.
Okay, I'm all ears. Tell me more.
This approach uses a formula based on return on equity, or ROE. Remember, ROE is all about measuring how efficiently a company uses its equity to generate profits.
Yeah, ROE is a key metric. A high ROE usually means the company is doing a good job managing investments and creating value for shareholders.
Right. So in this version of the model, you'd calculate the present value of residual income as ROE minus the required rate of return times the beginning book value, all divided by the required rate of return minus the growth rate.
Whoa, that's a mouthful. It seems like a lot to remember, but it sounds like this formula lets us see the relationship between ROE, growth, and the cost of equity all at once. It seems like it would be helpful, especially for those complex multi-stage models.
You got it. It's especially useful when we assume a constant growth rate within a specific stage of our forecast.
Okay, so to recap, we can either forecast each year's residual income individually, or we can use this ROV-based formula when we think there's a consistent growth trend. Is that right?
Exactly. It's all about choosing the right tool for the job based on the specific company we're looking at and the assumptions we're making about their future.
Got it. That makes sense. But I have to admit, those multi-stage models still feel a bit intimidating. They seem so complex.
I understand they can seem overwhelming at first. But they're really essential when you're dealing with companies that are going to go through different phases of growth over time. Very few companies grow at the same rate forever, right?
True. That's what we were talking about earlier. A company might experience rapid growth initially and then settle into a more mature phase as they grow. So how do we actually build one of these multi-stage models? What are the steps involved?
The key is to break down your forecast horizon into distinct stages, each with its own growth rate, ROE, and potentially some other unique assumptions. It's like building a valuation puzzle piece by piece.
So for example, I could have a high growth stage for the first 5 years, then a moderate growth stage for the next 5, and then maybe a stable growth stage after that.
Exactly. And for each year within each stage, we'd still use those core residual income formulas we talked about. We'd either project the residual income directly or use that ROE-based formula. It all comes back to those basic principles.
So we're essentially just applying the same tools, but adjusting them for each phase of the company's life cycle.
You got it. But we can't forget about that tricky terminal value we discussed earlier. It still has a big role to play even in multi-stage models.
Right, the terminal value. That's the value of everything that happens after our implicit forecast period, that final piece of the puzzle.
Exactly. And as we talked about earlier, there are a few different ways to think about it. We might assume that residual income eventually goes down to zero over time, or we might assume it remains stable at a certain level. It all depends on our assessment of the company's long-term competitive dynamics.
So even within a multi-stage model, we still need to choose the terminal value approach that fits the specific company and its industry.
You got it. But let's get out of the theoretical weeds for a minute and look at a real-world example. It'll make things much clearer.
Perfect. I love a good example.
Okay. Let's imagine you're an analyst trying to value Alphabet Inc., the parent company of Google, back in mid-2019 when their stock was trading at around $1,037 per share. You've got information about their book value, their cost of equity, and forecasts for their return on equity over the next several years.
Sounds like a pretty standard valuation scenario. So how would we tackle this using a multi-stage residual income model?
Well, the first step is to define those distinct stages in Alphabet's growth trajectory. We might have a high growth stage for the first few years, considering their dominance in online advertising, and then a more moderate growth stage as competition potentially heats up.
All right, that makes sense. What's next?
Then, for every year within each stage, we'd calculate the residual income. We could forecast it directly, or we could use that handy ROE-based formula, depending on the specific assumptions we're making. Essentially, we're figuring out how much extra profit Alphabet is generating each year above and beyond its cost of capital.
So we're isolating the value they're creating for shareholders each year.
Precisely. And then we need to discount each year's residual income back to the present value, using Alphabet's cost of equity as our discount rate.
Right, because money earned in the future is worth less than money today. Time value of money and all that.
You got it. Once we've discounted all those future residual income streams, we add them up to get the present value of residual income for each stage.
Okay, I'm following along. So we've got the present value for each stage, but what about that terminal value? We can't just forget about that, right?
You're absolutely right. The terminal value is still crucial. In this case, with Alphabet, we might assume that their residual income gradually declines as their competitive advantage weakens over time.
That seems reasonable. It's tough for any company to stay on top forever, especially in the fast-paced world of technology.
Exactly. So we calculate the terminal value based on that assumption of declining residual income and then discount that back to the present value as well.
So we have the present value of the residual income for each stage, plus the present value of the terminal value. What's the final step?
We add all those present values together, and that gives us the total intrinsic value of Alphabet's stock. And then we can compare that intrinsic value to the market price and decide if the stock is overvalued, undervalued, or fairly valued.
Wow, that was quite a journey. It's a lot to take in, but I think I'm getting the hang of it.
Yeah.
But you mentioned earlier that this model connects to the price-to-book ratio. Can you explain that a bit more? I'm not sure I quite understood what you meant.
Sure. It's all about what's called the justified price-to-book ratio. This ratio tells us what the price-to-book ratio should be, based on the company's fundamentals, including that expected future residual income.
So it's like a benchmark for evaluating whether a company's current price-to-book ratio is too high or too low.
Exactly. And the connection between residual income and the justified price-to-book ratio is pretty intuitive. If we expect a company to generate positive residual income in the future, its justified price-to-book ratio will be greater than 1.
Because investors are willing to pay a premium for that growth potential.
Exactly. On the other hand, if we expect a company to have negative residual income, its justified price-to-book ratio would be less than 1. Investors wouldn't be willing to pay full price for a company that's not expected to create much value.
Okay, that makes sense. So why is this connection to the price-to-book ratio so important? What does it tell us?
Well, it gives us insight into why some companies trade at much higher multiples than others. A high price-to-book ratio often signals that investors are anticipating strong residual income in the future, not just a lot of assets sitting on the balance sheet. It's about the company's potential to generate returns from those assets.
Ah, so it's a window into the market's expectations about a company's future profitability.
You got it. And it's also a handy way to check if our residual income valuations are in the right ballpark. If our model spits out an intrinsic value that implies a super high price-to-book ratio, it might be a sign that we need to double-check our assumptions.
So it's like a reality check. It helps us make sure we're not getting carried away with overly optimistic forecasts.
Exactly. Now, remember all those accounting nuances we talked about earlier? Well, they're especially important when we actually start using the residual income model in practice.
Oh, right. Those clean surplus violations and potential adjustments we need to make. Time to put our detective hats back on.
You bet. Let's explore some of those key accounting considerations you need to keep in mind when you're working with this model.
Lead the way, detective. I'm ready to uncover those hidden truths in the financial statements.
Okay, let's start with those tricky, clean surplus violations. Remember, this happens when certain items bypass the income statement and go straight to equity, which can mess with our residual income calculations.
Yes, those sneaky exceptions to the rule. What should we watch out for specifically?
Some common culprits are unrealized gains or losses on certain financial instruments, foreign currency translation adjustments, and certain pension adjustments.
So they impact the company's book value, but they don't show up in the net income, which means our residual income projections might be off.
Exactly. The first step is to thoroughly examine the statement of changes in equity and pay close attention to the related footnotes, looking for anything unusual.
So we're basically on a treasure hunt, searching for clues that something isn't quite right. What happens if we do find these violations? What do we do then?
If the violations are significant enough to impact our analysis, we might need to adjust our net income forecasts to include those items that bypass the income statement.
So we're trying to create a clean surplus situation,
Yeah.
even if the accounting rules technically allow these exceptions.
You got it. We want our residual income calculations to be as accurate as possible, so we need to make sure we're considering all the relevant changes in equity.
Okay, that makes sense. Now, what about those balance sheet adjustments we discussed earlier? Things like off-balance sheet items, intangible assets, and one-time events. Do those come into play here as well?
They absolutely do. These adjustments can significantly affect both the book value of equity and the return on equity, which are the key drivers of residual income.
Right, I see how that works. A change in the book value affects the equity charge and therefore the residual income. And a change in ROE impacts both the residual income calculations and potentially our growth forecasts.
You've got it. It all starts with making sure our balance sheet accurately reflects the company's true economic position.
Okay, so where do we begin? What are some common balance sheet adjustments we might need to make?
Well, operating leases are a classic example. Under operating leases, a company essentially rents an asset, but the asset doesn't actually show up on the balance sheet.
So it's like they're using an asset without having to officially report it.
Exactly. And this can distort the book value of equity and ROE because it's as if the company is using an asset without having to pay for it up front.
Interesting. So how do we adjust for operating leases in the context of residual income valuation?
One common approach is to capitalize those operating leases. We essentially bring those assets and liabilities onto the balance sheet, just like we would if they were financed with traditional debt.
So we're basically pretending they bought the asset outright.
Precisely. This adjustment will increase both the book value of assets and liabilities. It will also affect the net income calculation because now we're accounting for depreciation expense on those leased assets.
So it's a chain reaction that starts with recognizing those off-balance sheet items and ripples through our residual income calculations.
Exactly. Now let's talk about intangible assets. These are assets that don't have a physical form, like patents, trademarks, and goodwill.
Ah, yes. Those tricky assets that are often based on estimates and can fluctuate quite a bit over time. How do those affect our residual income valuations?
They can be a bit tricky. Including them in the book Value of Equity can inflate the equity charge, potentially understating the residual income.
Because we're assuming the company needs to earn a return on those intangible assets, even though they might not require ongoing investment.
Precisely. And the amortization of intangible assets, especially goodwill, can distort the net income and ROE calculations.
Because those amortization charges are non-cash expenses, they lower net income without representing any actual economic loss.
You got it. So we need to be careful when dealing with intangible assets in the context of residual income valuation.
Okay, so how do we handle them? Do we just ignore them completely?
We can't ignore them entirely, but we might need to make adjustments. One option is to adjust the book value of equity by removing or reducing the value of certain intangible assets.
So we're essentially taking them out of the equity charge calculation.
Exactly. Another approach is to adjust the net income calculation by adding back the amortization of intangible assets.
So we're neutralizing the impact of those non-cash charges.
You got it. These adjustments can help us get a clearer view of the company's true economic profitability.
Right, that makes sense. Those are some really useful strategies for dealing with intangible assets. What about those one-time events, those non-recurring items that can skew the numbers? How do we handle those in the residual income model?
Ah, yes, non-recurring items. Things like restructuring charges, asset write-downs, or gains from selling a business unit. They can have a big impact on a company's earnings in a particular period but aren't expected to continue in the future.
So they're not a good indicator of the company's long-term profitability.
Exactly. So we need to adjust for them when we're using the residual income model. We want to isolate the earnings that represent the company's core operations.
So how do we do that? Do we just erase them from the income statement and act like they never happened?
Not quite. We need to identify those non-recurring items and remove them from the net income calculation, creating a pro forma income statement that reflects only those recurring earnings. Then we use that adjusted figure to project future residual income.
Okay, so we're basically cleaning up the income statement, filtering out the noise to get a better view of the company's true earnings power.
You got it. And these adjustments are essential for accurate and reliable residual income valuations.
This conversation is really making me think about the importance of looking beyond the surface and not taking those accounting numbers at face value. It's like we're financial detectives, uncovering the real story hidden in the financial statements.
I couldn't agree more. It's all about critical thinking and using our judgment. And sometimes we need to consider the human element as well. Companies don't always play by the rules and might try to manipulate those numbers to make themselves look better than they actually are.
All right, earnings manipulation. We can't forget about that. What are some of the red flags we should look for?
One common trick is revenue recognition manipulation. Companies might try to book revenue too early or inflate their sales figures. For example, they might ship products to customers who haven't actually placed orders, or they might recognize revenue before a service is completely delivered.
That's sneaky. Anything else we should be wary of?
Another common tactic is expense manipulation. Companies might try to postpone expenses or capitalize costs that should be expensed immediately, all to make current earnings look better than they really are.
So the key takeaway here is to be aware of these potential red flags and carefully scrutinize the financials for any signs of earnings manipulation.
Exactly. We need to be skeptical, challenge those numbers, and remember that things aren't always what they seem, especially when those numbers seem too good to be true.
Okay, I'm starting to feel like a seasoned financial detective. I'm ready to tackle any accounting shenanigans I come across. But before we wrap up this accounting deep dive, I have one more question about those international accounting differences we talked about earlier. Any practical strategies for dealing with those variations in reporting standards?
Absolutely. One approach is to adjust the financial statements of those foreign companies so that they align with the accounting standards you're using for your valuation.
So we're essentially translating those foreign financials into a language we can understand.
Exactly. Another option is to use valuation metrics that are less sensitive to those accounting differences. Think about things like market multiples, like price to earnings or price to sales.
So those multiples can give us a quick and dirty way to compare companies from different countries without getting bogged down in the accounting details.
You got it. It's all about picking the right tool for the job and being mindful of the potential challenges we might encounter.
Okay, I feel much more confident about tackling residual income valuation now, even with all these accounting intricacies. But we haven't really discussed that mysterious terminal value in detail yet. We've touched on it conceptually, but how do we actually estimate it in practice?
That's a great question. Estimating the terminal value is often one of the most challenging aspects of a multi-stage residual income valuation. But let's break it down and make it a bit easier to grasp.
Okay, I'm ready to dive into the world of terminal value estimation. What are the key things I need to understand?
Well, as we've discussed, the terminal value represents the value of all the cash flows we expect beyond our explicit forecast horizon. To estimate it, we need to make assumptions about how that continuing residual income will behave over the long term.
Right, like whether we expect it to gradually decline to zero or persist at a stable level. But how do we actually translate those assumptions into concrete numbers?
There are a few different approaches depending on the assumption we're making. Let's start with the assumption that residual income will eventually fade to zero over time. This often makes sense for companies in highly competitive industries where we expect those competitive forces to chip away at any excess profits.
That makes sense.
Yeah.
Competition tends to drive profits down over time, right?
Yeah.
So how do we calculate the terminal value in this scenario when we assume residual income eventually disappears?
One approach is to use what we call a persistence factor. It's a number between 0 and 1 that represents how quickly we expect that residual income to decline.
So a persistence factor of 1 would mean the residual income goes on forever, and a persistence factor of 0 would mean it vanishes immediately.
Exactly. And anything between 0 and 1 represents a gradual decline over time.
Okay, that makes sense. But how do we actually use this persistence factor in the calculation?
One common formula is to take the final year's residual income, multiply it by 1 plus the persistence factor, and then divide that by the required rate of return minus the persistence factor.
So we're basically discounting that final year's residual income into perpetuity, but with a twist. We're factoring in that gradual decline using the persistence factor.
Exactly. This approach can be useful for modeling the slow erosion of competitive advantages over time.
Okay, I see. So what about the other scenario where we assume the residual income continues at a stable level forever? When would that be a reasonable assumption?
That assumption is more likely to be appropriate for companies that have those durable competitive advantages we were discussing earlier. Things like powerful brands, unique intellectual property, or significant economies of scale. These are the companies that can withstand competition and maintain their profitability over the long haul.
Those are the companies we all dream of finding, the ones that can keep churning out profits for investors year after year. So how does the terminal value calculation change when we make this stable residual income assumption?
It actually becomes a bit simpler. We can essentially treat that continuing residual income as a perpetuity and discount it using the required rate of return.
So we take the final year's residual income and divide it by the required rate of return, just like valuing a bond that pays a coupon forever.
Exactly. That analogy is perfect. It's all about figuring out the present value of an ongoing stream of cash flows.
Okay, I'm feeling a lot more comfortable with these terminal value calculations. But choosing the right assumption is crucial, right? It feels like that decision could have a huge impact on our valuation.
You're right. Picking the right assumption for continuing residual income can be tricky. It's not always black and white whether a company's competitive advantages will fade, erode, or persist over the long run.
So how do we make that judgment call? What factors should we consider?
Well, this is where the art of valuation comes in. It's not just about plugging numbers into a formula. It's about analyzing the company's industry, their competitive position, their track record, and making a judgment call about the long-term sustainability of their excess returns.
So we need to consider things like market share, pricing power, cost structure, innovation, and whether they've been consistently profitable in the past.
Exactly. We're trying to create a picture of what the company's future might look like, and that requires a deep understanding of their current situation and the dynamics of their industry.
This highlights how important it is to go beyond just looking at the numbers and really dig into the company's business and its competitive landscape. It's like we're putting together a complex puzzle, using every bit of information we can find to create a complete picture.
That's a great way to put it. And remember, there's no one-size-fits-all solution for estimating the terminal value. It's all about using your judgment and selecting assumptions that are reasonable and supported by the evidence.
Okay, I'm feeling much more confident about tackling these terminal value estimates now. But before we wrap things up, I'm curious to hear your thoughts on the bigger picture. What are the pros and cons of using the residual income model in general? When is it a good choice? And when might we want to consider other valuation methods?
That's an excellent question. Let's start with the advantages. One of the biggest pros of the residual income model is that it's focused on economic profitability. It doesn't just rely on accounting profits, which can sometimes be misleading.
Right. It factors in the cost of capital and tells us whether a company is truly creating value for its investors, that A-plus performance we were talking about.
Exactly. This focus on economic profitability can be especially useful when we're looking at companies that aren't generating positive cash flow yet, or companies that have unpredictable dividend payments.
Because in those situations, traditional valuation metrics might not be very helpful or reliable.
You got it. Another big plus is that the residual income model is less sensitive to those terminal value estimates compared to other discounted cash flow models.
Because more of the company's value is reflected in the earlier years of the forecast, when our predictions are usually more accurate.
Exactly. And that can be a real advantage when we're dealing with companies that have long growth trajectories or very uncertain terminal values.
So it helps us avoid relying too heavily on those long-term forecasts, which can be pretty speculative.
Precisely. And finally, the residual income model is pretty easy to grasp and apply. The formulas might look intimidating at first glance, but once you understand the core concepts, they're actually quite straightforward.
And all the data we need is readily available in a company's financial statements, right?
Absolutely. It's a user-friendly model that doesn't require any special data or complicated calculations.
Okay, those are some pretty compelling advantages. But I know every model has its drawbacks, right? What are some of the potential downsides of using the residual income model?
Well, one of the main drawbacks is that it relies heavily on accounting data, which, as we've already discussed, can be subject to manipulation or require adjustments.
Right, those pesky accounting games. And we know that accounting standards can differ significantly across countries, which adds another layer of complexity.
You're absolutely right. And this dependence on accounting data can make the residual income model less reliable than some of those market-based valuation approaches.
Because those market prices, in theory, reflect all available information, both financial and non-financial.
Precisely. Another potential downside is that the model can be sensitive to the discount rate we choose.
Right. That discount rate reflects the opportunity cost of capital. Even a small change in that rate can have a big impact on our final valuation.
Exactly. And figuring out the appropriate discount rate can be a challenge, especially for companies with complex capital structures or operating in risky industries.
So we need to be extra careful to choose a discount rate that accurately captures the riskiness of the investment.
You got it. And one more thing to consider is that accurately forecasting residual income itself can be tricky. It requires us to make assumptions about future profitability, growth, and the sustainability of competitive advantages, which can be challenging, especially in dynamic industries or for companies going through big changes.
Right? It's like trying to predict the future, which is never easy.
Exactly. So it's crucial to be realistic, consider multiple scenarios, and assess how sensitive our valuation is to different assumptions.
Okay, so the residual income model has its strengths and weaknesses, just like any other tool. It's not a magic solution, and it's not always the best approach. So how do we know when to use it?
That's the million-dollar question. The residual income model tends to work best for certain types of companies.
Okay, I'm intrigued. Tell me more. When does this model really shine?
One category is companies that don't pay dividends or companies with really unpredictable dividend payments, making the dividend discount model less useful.
That makes sense. What are some other situations where the residual income model might be a good choice?
Another good scenario is when we're looking at companies that have negative free cash flow in the near term, but are expected to generate positive free cash flow in the future.
Because traditional discounted cash flow models might not work well in those cases with those early negative cash flows.
Exactly. And a third good use case is for companies operating in industries with high growth potential or a lot of uncertainty about their terminal value. The residual income model tends to handle those situations better than some other valuation approaches.
Okay, those are some really useful guidelines. So, are there any specific situations where we should probably avoid using the residual income model?
Definitely. One situation to avoid is when a company has a lot of those clean surplus violations we talked about earlier.
Right, those accounting exceptions that can mess up our residual income calculations.
You've got it. Another situation where it might not be the best tool is when those key drivers of residual income, like book value and ROE, are difficult to predict.
Because if we can't forecast those values reliably, our whole model falls apart.
Precisely. But it's important to remember that these are just general guidelines. The best valuation approach always depends on the specific circumstances we're dealing with.
So it's all about using our judgment and choosing the model that makes the most sense given the available information and the purpose of our valuation.
Exactly. And we can even use the residual income model in combination with other valuation methods.
Right. We don't always have to pick just one.
Hmm.
Sometimes it's helpful to use multiple approaches to get a more well-rounded view of the company's value.
Absolutely. By comparing the results from different models, we can be more confident in our valuation and spot potential areas where our assumptions might be off. It's about being thorough and using every tool we have.
Okay, I'm feeling much more comfortable and confident with the residual income model now. But I know from experience that applying these concepts in practice, and especially on the CFA exam, can be a bit tricky. Any practical tips to help us avoid common pitfalls and make sure we're using this model effectively?
Well, one of the most important things is to make sure your forecasts are realistic and well supported. Remember, garbage in, garbage out. The quality of your valuation depends entirely on the quality of your assumptions.
Right, I can't just pull numbers out of thin air and expect to get a credible result. I need to base my forecasts on solid research, industry analysis, and all those company-specific factors we were discussing.
Exactly. And speaking of doing your homework, don't forget about all those accounting details we discussed. They can really make or break your valuation.
Right, those clean surplus issues, those off-balance sheet items, those intangible assets. It's like we need to become financial detectives, carefully examining those financial statements for any clues that something might be amiss.
You got it. Don't be afraid to dig into those footnotes, make adjustments to the data if necessary. Sometimes those numbers don't tell the whole story, and we need to do some digging to uncover the full picture.
It's like we're financial journalists, right?
Yeah.
Uncovering the truth behind those seemingly straightforward numbers.
Exactly. And while you're digging into those numbers, remember to test out different terminal value scenarios. That terminal value can have a big impact on the final result, so it's important to explore different assumptions.
Right. We might run our model with a few different persistence factors or try out different growth rates for the continuing residual income. It's all about seeing how sensitive our valuation is to those changes.
You got it. Sensitivity analysis is a powerful tool. It helps us understand the range of possible outcomes and identify the key drivers of our valuation.
Makes sense. We don't want to be overconfident in a single point estimate. We need to recognize that there's a range of possibilities.
And lastly, remember that you can use the residual income model alongside other valuation approaches.
Right, doesn't have to be in either situation. We can use multiple methods to get a more complete picture of the company's value.
Exactly. By comparing the results from different models, you can check your work and see if there are any red flags or areas where you might need to refine your assumptions. It's all about being comprehensive and using every tool at our disposal.
This has been incredibly helpful. Thanks so much for sharing these insights and practical tips. I feel much more confident about tackling residual income valuation now.
You're very welcome. And remember, practice makes perfect. Work through as many practice problems as you can get your hands on. Try to find real-world examples to analyze, and don't be afraid to really challenge your assumptions. The more you work with this model, the more comfortable and confident you'll become.
Great advice. I'm definitely going to put that into practice. And to all my fellow CFA candidates out there, don't be intimidated by residual income valuation. It's a challenging topic, but with a little effort and dedication, you can master it and ace that exam.
And remember, it's not just about passing an exam. It's about developing a deep understanding of what truly drives a company's value. That's a skill that will be valuable throughout your career in finance, no matter what path you choose.
Couldn't have said it better myself. And on that note, we'll wrap up this deep dive into residual income valuation. We hope you found it helpful and insightful. Keep learning, stay curious, and as always, happy investing.